Hello, everyone. Welcome to this episode of The Pitch. I'm Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. We're going to have a lot of fun today talking about where we should be thinking, where we should be leaning into given the uncertainty in the markets right now. Certainly volatile times with so many of the S&P members. I think it was 30 to 40% of the S&P, if I remember right, reporting earnings this week alone. So a lot happening. We have the Fed meeting. We have a lot going on. But at the end of the day, the question always remains, where should you be placing your bets? Where should you be focused? Where are the actionable opportunities using the charts? And on StockCharts TV, we love helping to point you in the right direction. Today, we have three wonderful guests to help us do so. Before we get to the guests and highlight some of their expertise, I want to remind you two things. Number one, for all the information about this show, The Pitch, go to StockCharts.com/The Pitch. You'll see this is a monthly show. We have new guests every month sharing their latest ideas. Should be a lot of great content to review. If you want to check out any of the previous episodes of The Pitch, by the way, go to StockChartsTV.com. That's our on-demand platform. Just search for The Pitch, and you will find all of our previous episodes with some fantastic guests giving their take on the current markets and where to be leaning. Right now, with a busy week, with earnings, with the Fed, with everything, we need to bring in the big guns. We need to have some help helping us make sense of where to be focused. We have three fantastic guests today. I want to welcome on my guests. First, we have Mark Newton. Mark's the president of ML Newton Advisors, coming to us from the Northeast, from Connecticut. Mark, you've been a frequent guest on the Final Bar. You always do a great job making sense of the markets, bringing some actionable ideas with you. So thanks for joining us today.
Thank you, Dave. It's great to be here.
Guest number two, we have Jeff Hughes. Jeff is the president and chief investment officer at JWH Investments, coming to us from Minneapolis. Jeff, welcome, and thanks for joining us today.
Privilege, Dave.
Finally, we have Greg Schnell. Greg hopefully is familiar to many of you. He does a great job hosting some of the content on StockCharts TV, a frequent columnist on StockCharts.com. Greg is the founder and chief technical strategist at GregSchnell.com. Coming to us from Alberta, Canada. Greg, welcome today.
Hey, thanks, Dave. Thanks for the invite.
And I'm based in Redmond, Washington. So as I mentioned before, as we were chatting, we have the continent of North America covered well by who's represented today. But most importantly, let's focus on the charts. Let's focus on where those actionable ideas could be. So the general game plan for today, we'll give each guest panelist an opportunity to share 5 ideas, to pitch you their ideas. After that, we'll get together as a group and discuss the merits, discuss the strengths and weaknesses of our picks, and where we should be focused going forward. So now let's get to the charts. All right, so we're starting with Mark Newton. And I should have mentioned, Mark, before we got started, we're of course recording this on one of the few days in 2021 that we're actually seeing red on the monitors, where the S&P and other indexes are actually going down. The good news is these bear market phases only last for a day or two, from my own experience so far in 2021. But having said that, we're pulling back a bit, but we want to focus on the big picture, focus on your ideas. Take it away. Start with BMY.
Thanks, Dave. Well, Bristol Myers is one of my favorite ideas right now within the healthcare space and really within the broader market. What you see is a chart that on this screen goes back since really over the last 24 years. And what I find really attractive about this is that we peaked out in 1999 and have formed literally a large 20-year base. The pharma space right now acts very, very well. For most that are involved in healthcare, we're at a time of the year where traditionally we do see more defensive outperformance, and the pharmas are doing much better than biotech. But BMY, rallied up very sharply from 2009. 12 years ago and peaked out initially in 2016. We went sideways for almost 5 years. And now we're moving up to really test the highs that were hit back 5 years ago. So this is really attractive to me, specifically based on these prior highs. This is what I view to be a large cup and handle chart that's gone on for the last 2 decades. So if anything, one would want to position long here and continue to really add to longs above $68 and thinking this should easily, get up to the 80s to 90s in the years to come. But this has been, really a consistent wealth builder for many that are familiar with this stock since I believe it came public in the 1920s, 1930s, and it's averaged about 13% on average per year. So it's been a great long-term performer. The near term might seem choppy to many, but it's forming what I believe to be a great base. And I think that, the stock is just in the process of trying to break out of this long-term pattern.
Perfect. Chart number 2, CRWD CrowdStrike.
Yeah, this has been a very popular stock for many, but as many notice, we really haven't done a whole lot in the last 4 or 5 months. So it's had, phenomenal gains since last March's lows. The stock has been up, literally, 20, at least quadrupled or so in price. But, not much really in the last 5 months. But what really is attractive to me is what the stock has done just since this spring. And so we've rallied up, we've managed to challenge those highs and move sideways. This is really a bread and butter type pattern that I love seeing, as opposed to just buying these stocks which are at, multi-year highs and continuing to show very overbought situations. I'd rather buy a stock that's had a huge run and then literally goes sideways for a period of time and then attempts to break out of that back to new all-time high territory. So this is exactly what we're seeing, where momentum is really not that overbought. And some might say, on a daily basis, why would I want to buy this stock now? But it's really with regards to the longer term structure, the weekly and the monthly, as to how this is shaping up, as to why this is attractive to me. So, it's part of a number of different of these cybersecurity ETFs where, it should honestly offer some very good outperformance. But, it's all technical as to why I'm choosing this. And I think, at $256, movement back up above 270 would get you up towards at least, 320 to 340 in short order. So I like CrowdStrike quite a bit.
Chart number 3, we're switching gears to MasterCard.
Yeah, so this is one of my favorite ways of playing the financial space right now, with yields continuing to be quite low. And many have looked at the banks, which have made a record run. I prefer to look at, the credit card companies and the ones that are specifically, payment processor types like MasterCard, where, how many people have honestly used cash in the last 12 to 24 months? And many people almost exclusively are using debit cards and credit cards, and MasterCard, technically, what's appealing to me is that, similar to the other stocks I mentioned, you've had a huge run up and then it's gone sideways for a period of time. And now literally the last few weeks, you've run up to really attempt to challenge, if not exceed, these recent highs. So, to me, buying a stock within 5% of its all-time highs, it's gone, sideways over the last, 6 months or longer, but it's had a history of having big run-ups, is very appealing to me. So I like the stock to move into the mid 400s, and I'm comfortable, with MasterCard as really a buy and hold.
Very good. Now to consumer and Home Depot.
Yeah, this is part of the so-called housing boom that we're experiencing right now. This secular, movement into home building and housing, and the massive appreciation we're seeing in housing prices, and the exodus of people out of the major cities into the suburbs. And so, this continues to be one of the best performing stocks that we see within the retailing space. And many would say, well, it's overbought, but yet, structurally, it really hasn't given us any reason to want to avoid it. It seems to move in these sort of stair-step patterns where you have a big move off the lows. And, we saw last March, the stock was at 140. So it literally doubled, and then it went sideways for nearly a full year. And now it's starting to push up again. So, I like the fact that we broke out back in the spring and consolidated, and literally just the last few weeks have shown some excellent strength in forming a very nice tight base to this consolidation. So I think the stock is in the process of challenging and should exceed those highs, despite this being sort of a tricky time, seasonally speaking. This stock really shows very little evidence of any technical deterioration, and it's certainly one that I'd be very comfortable with owning. For those that want to use stops, you could simply use 300, the level near the last lows, but I think the stock is headed back to all-time highs again.
Very, very good. Your last pick today, Mark, is Sherwin-Williams, SHW.
Yeah, so this is another stock that I included as part of my sort of secular theme of housing boom. And of course, with everybody moving to the suburbs, you certainly need lots of paint for all the houses that are going to be built. And you see this stock has been a consistent outperformer. And really just since last March, we've more than doubled in price. The stock was down near $100. And for some, that might be a reason to avoid it. But, if you look at specifically how the stock has just performed over the last few months, it's been basing very nicely and has moved sideways. And so that's helped to alleviate some of those overbought conditions. But just in the last few weeks, we're starting to push up and to really test those highs again. So, yet again, this is a case of a long-term, a really good outperformer that's had a chance to consolidate and is now starting to turn higher. And it fits technically and really marries, the technicals along with what I believe is a great long-term fundamental thesis for why one would want to own stocks in this industry. So, materials, what you call chemicals, and really something that is showing very good signs of strength of late.
Mark, those are 5 fantastic picks. Let's bring up the list very quickly and just remind everyone where you did. We started in healthcare. We went with Bristol Myers Squibb, BMY. We then have CRWD in technology. Also in tech, we have MasterCard. Then we have Home Depot and consumer discretionary, and then materials, Sherwin-Williams. Just a quick question to wrap up your portion here, Mark. It strikes me, given all of the short-term volatility, all of the short-term uncertainty, I'm struck by the fact that you started with a monthly chart of Bristol Myers Squibb, and you're talking about the long-term, the real long-term perspective. How do you balance the long term and sticking with things that are working over time versus dealing with the short term and just the uncertainty and the volatility?
Well, uncertainty is something that I think, is great normally to buy into. I mean, we haven't really seen that uncertainty reflected in most of the charts that I've mentioned. Many are still trending up and doing very, very well. So I often take the longest time period that I can find as a technician. I want to find where the stock has made those former highs and lows. And in this case, the stock already had a fantastic long-term history, but these long-term bases is what many people oftentimes can use to really deliver phenomenal returns when they start to break out of these bases. And many are familiar with the FANG stocks. Those obviously have a period of going sideways for lengthy periods of time and then breaking out and having phenomenal gains. We as technicians can really find those things. So if I can marry the long-term with also the short-term and finding stocks that are breaking out short-term, but have great long-term pictures, I think, that's just even better.
That's a great answer, Mark, and I appreciate you bringing a good long-term perspective to get this discussion started. Thanks for the picks. Thanks for joining us today. We'll come back to you at the end for the discussion. Let's move on to number 2. We have Jeff Hughes. Jeff, thanks again for joining us today. We, as we were talking before the show, we're actually going to start with the RRG, the relative rotation graph. And I'll just remind people, if you're not familiar with Julius de Kempener's visualization, it's beautifully done, I think, on StockCharts, but his show Sector Spotlight on StockCharts TV does a great job highlighting this methodology and how to use it. But start us here. Introduce us to your 5 picks, Jeff.
Absolutely, Dave. Thank you. So first of all, my strategy is really built around high relative strength. And so we're looking for stocks that are leading the market, beating their benchmark. And the upper right-hand quadrant, which is the leading sector, really looks at stocks that have 30-week high relative strength or momentum that is greater than the market. And actually something that's north of the center line, the median line, actually has improving momentum. And so we've got positive relative strength and accelerating momentum of relative strength, or the second derivative. So the leading quadrant to us are high probability outcome stocks. And those that are in the improving quadrant are what we would consider hopefuls, those that are moving toward that breakout point. And so that's where our stock picks are derived from. So with that, I'd start with Dexcom, which is our top pick. And really, we are trend followers. So we're looking for stocks that are trending positively. And we consider, the 10-week exponential moving average to kind of define the trend more or less. Stocks that are trading materially below that level are not of interest to us. They're generally consolidating and not trending up. And so, our view is basically to identify stocks that are in uptrends and stick with that and orient ourselves around stocks with high momentum, high relative strength. And then finally, we're looking for classical chart patterns and breakouts of consolidations. And what we see in Dexcom is all of the above. We've got a stock with positive momentum, a strong trend. In the bottom panel, we actually show the linear version of the RRG. So we can see that both lines, the red, which is the relative strength line, and the green, which is its second derivative, the momentum of relative strength, are both positive and turning up. And so that confirms all of our suspicions. And so visually, when we look at the chart, what we see is a range that's existed for a multi-month period, actually going back a year. And if we were to draw a trend line across the largest closing point back in, I believe, August of last year, we would then be able to identify that as something of a neckline or key resistance. And then if we were to put kind of a saucer shape underneath the prior two lows, we would identify this as kind of a classic double bottom base pattern. And so the emergence above that key resistance resolves that pattern and actually gives us the ability to project an upside target to around $600. Now, because we're trend followers and as traders, we want to manage risk, we use a risk budget with a stop loss. Here we would come up with a stop loss of about 422, which gives us a positive risk skew of about 3-1.
Very good. And I love the breakdown of the risk versus reward. Let's go to chart number 2, PayPal.
Yeah, PayPal is a fintech play. It's a leader in its industry. The stock went out around 296 or so last I looked. Similar sort of strategy. I won't repeat all of it, but all of our picks kind of have the exact same approach. So we look at that breakout above the prior high, which was established in February or so, and that breakout leaves an identifiable consolidation or base pattern from which we can project forward an upside target above that 300 level to around 395. Again, we want to budget our risk to around 275, which establishes a very attractive 5-1 positive risk skew. Again, looking at the bottom panel, we can see that both relative strength and the momentum of relative strength are both turning up and accelerating in a positive manner. And so we like the momentum characteristics as well as the chart pattern.
Very good. Now we go to consumer and Lululemon.
Yeah, Lululemon. By the way, the other two stocks are both reporting this week. I believe PayPal tomorrow and Dexcom on Thursday. Lululemon is the only name within our bailiwick that isn't reporting this month. It's actually a September 2nd report date. So we may have some time for this one to play out. But again, we like that pattern. It's very similar to Dexcom. Extends back, on a multi-month basis. To last fall, where it put in its weekly closing high, and it's just broken out. And of course, all three of these stocks have made new all-time highs as they've broken out. And so that gives us a lot of confidence that we can resolve this double bottom base pattern that we've identified here with positive momentum and positive relative strength. We see the stock trading up to around 525. We'd use a stop loss at 360 for, again, a very attractive 5-1 positive risk skew.
Very good. Now, ServiceNow, we go to technology, NOW.
Yeah, so this falls in the hopeful category. ServiceNow is a software enterprise cloud computing company. The stock's trading around 578 last I looked. Key resistance is 600. It has not yet penetrated that level. However, should it break out above that $600 level and sustain that breakout, the pattern again is kind of your classic sort of bottom pattern. We call it just kind of a small base pattern in an uptrend. And that breakout projects to about 750. We'd use 550 as a stop loss for a 3-1 positive risk skew here. And we really like the acceleration and the momentum at the bottom of the chart, which suggests that relative strength is going to follow through to the upside. And so we're hopeful that that will resolve favorably.
Last one is Twilio, TWLO.
Twilio is a disruptor. It's actually a Kathy Wood stock, so beware. They operate in the application software communication space. Stock went out around 380 or so last I looked. Key resistance is 440 on a weekly closing basis. A breakout above 440 would project to 650. And frankly, I think that the stock looks favorable enough at this point that there's a very high risk reward payoff. If you were to own the stock here and use a 360 stop loss, it counts to around a 13-to-1 positive risk skew. So it hasn't broken out yet. The bet is that it will resolve higher. They report earnings after the close, I believe, on Thursday, as does ServiceNow. So again, both of these stocks report this week, and they're both hopefuls. And you've got a big payoff on the Twilio should it resolve favorably.
These are 5 fantastic charts, Jeff. Let's look at the list very quickly. So here we have, starting in healthcare, Dexcom, and then we go into technology. We have 3 technology names: PayPal, ServiceNow, and Twilio, and then Lululemon from consumer discretionary. It strikes me, Jeff, as you were talking about your approach and sort of describing them, every one of them, you very clearly defined the risk and the reward. So on PayPal, for example, you had sort of the measured move, like the upside based on this basing pattern, but also define the risk. Can you talk about just how that risk plays in? I mean, why is it important to think about the reward versus the risk as opposed to just looking for an objective and being done?
Yeah, I think you need to protect your capital at all times. That's the key. Live to fight another day. We define risk basically by looking at, idiosyncratic volatility of each security through its average true range. And we try and come up with, a rational sort of ratio. We're really trying to get something better than 3-to-1. And by using a 1.5 to 2.5 sort of range for average true range, we can come up with a decent stop loss or risk budget that remains above trend.
Very, very good. And I appreciate you talking through that, Jeff. Thanks for the picks. Thank you so much for describing them. We'll come back to you in a moment so we can discuss all of them together. Let's go on to our third guest today, Greg Schnell. Greg, as we're looking at this market environment again, the key is identify where there may be opportunities given uncertain markets, uncertain times. You're starting us in the materials sector with FCX. Take it away.
So FCX had a big run, obviously, off the $4.80 low to $46, so a 10x run. The big thing that I see coming out here is that this whole material space is set to continue to explode higher. We continue to put pressure on copper, both on grid enhancement as well as the charging systems and new electric cars. So there's lots of reasons to like this. I like the bounce off the 40-week moving average. I like to buy commodities when they've pulled back a bit. We've got the full stochastic down around 20%, and so I'm looking for an upside turn here. We are currently sitting just below the 10-week. You can see the stock fighting between the two, the 40-week and the 10-week, but any breakout here, and I really want to own FCX. I like the PPO coming back down around 0 and resetting before it starts to turn higher. What you see on good, strong stocks, and if you go look at an Apple or an Amazon or something like that, is you'll see that their PPO momentum indicator rarely goes below 0. And I think what we're looking at here on Freeport-McMoRan is the highest PPO reading we've seen in 5 years. The stock is getting more and more momentum than we've seen in a long time. And so this nice pullback gives us an opportunity to load our boat and start floating with Freeport-McMoRan.
Very good. Chart number 2, we're staying in the same sector, materials, going to Southern Copper.
And I'm taking another shot at copper here, and the reason I like this one is just it's a small cap, and well, it is a large cap, but relative to Freeport, it's different. I would just say I like it because it's got the PPO resetting at 0. I'm sitting here right at the combination of both moving averages, sitting ready to cross, and if I get any sort of breakout at all here, I want to take this chart a lot higher. Again, I like the material that they're based on. I like the size of the company. We're not really small, but we have an opportunity for big upside movement here. So that one impresses me. I like the full stochastic just coming in around 20%, trying to turn higher. The scooter ranking that's on the top of the charts is a method of ranking a stock against peers. So this is the large cap peer group, and it's pulled all the way down into the bottom. And one of the things I like about commodities is as they come out of the base, trying to buy them on the way up. And then when they start to get near the top, you want to roll over. So on that May 10th top that we saw in almost everything, and I think Freeport McMoran on that day had, 50 million shares traded or something. It was an absolute big blow off top in terms of volume, and the stock started to correct on May the 10th. And literally we've seen a move into growth and out of the material sector from that day. And now I wouldn't be surprised to see as we head into the fourth quarter, we put a return back into the materials and start to ride this higher.
Very, very good. We're now to another sector that's had a bit of a pullback recently, energy and Canadian natural resources.
So Canadian Natural is Canada's largest oil company. They're real close to 50-50 split on natural gas and oil. What I like the most about them, obviously, I live in the energy city of Canada, which is Calgary. So we always have an ear to the ground on the oil business. But the big thing I like here is continuing tightening in inventories worldwide. OPEC continues to show discipline. And so we have a tightening situation for oil inventories. These companies are incredibly cheap. At $70 oil and at $4 gas, this thing is literally set up to explode to the upside. It's been held back for a couple of reasons, not being able to sell product outside of Canada. We've been pipeline constrained, and one of those constraints comes off this fall, and one comes off next year with a pipeline to the West Coast. So I think as Canada's largest company, if you're looking for some big uptrend, this one has it. Now, that's a little bit of the background, but what I like here is that big breakout out of a long high. I think that goes all the way back to 2010. So we're breaking out of this base and we're just starting to move higher. They bought a whole bunch of assets from Shell and Devon, and now it looks to me set to explode to the upside. So with maybe I'll just stay on that chart for a little bit more, but with the turn in the full stochastics here, I'd be looking for this to start to move higher. What you typically see in a bull market is a full stochastic bounce in around the 40 to 50% level. In a bear market environment, you see exactly the opposite, where it just kind of stalls there and can't get above it. So as Canada's, I would say, more frugal developers of oil and gas, this chart has really good financial structure behind it. But if there was a place to look for a bounce, it's right here as we pull back to this support level on the chart. The scooter ranking is based on large cap stocks, but what you'll see is it's sitting up in the top quadrant. And again, the longer it can stay up in the top quadrant, and you can see it hasn't been there for 5 years. So I think we're in a new stage for this stock, and it looks set to go to the top. So really like that one.
Very good. Now we switch to the US. In technology, we go to Square, SQ.
Yeah, and one of the things I like about Square, so I have a big consternation about the overall setup for technology right now. So that's one of the reasons I didn't skew so heavily to them. But what we see here is the PPO trying to turn up off the very bottom after coming down to zero and resetting. So while the stock has migrated sideways for 6 to 8 months, we see the PPO now starting to turn back up again. And my suggestion would be this starts to make its next leg higher. I'm a real big follower of momentum, so I like it bouncing off zero. The moving averages have just touched each other, so they're sitting right there as support. The stock is trying to break out to a new all-time high. I think we all know that Jack is involved in this one as well as Twitter, but he said his biggest thing is to get Square working with the cryptocurrency. So I think there's a lot of upside from the technology perspective in Square. And the one hesitation I have is that PPO momentum wave is very low. And if there's just so many technology stocks that are trying to break out to new all-time highs. PayPal was just shown. As I go around and look, there's Twilio, there's a whole bunch are at resistance. So we really need to see these stocks break out as a group. And maybe it takes till whatever, August or September before they finally have the momentum. But I like Square. I like the PPO turning up again right near the zero line. I want to see that scooter ranking at the very top. I want to see that get back up into that positive above 75. So I always put the line there in my thinking on the line at 75 is you're in the top quadrant of all of the stocks to compare to. So you have enough heft to really start pushing, and charts like Jeff, where he showed the relative strength, that's what this chart suggests. It's outperforming its peers. It starts to move higher. So I really like it from that perspective.
And now your fifth chart is PTC.
Yeah, so this is a technology software company. And what I like is it really hasn't been breaking out in 2021. It ran up to the highs in February, and you might remember there was a big technology pullback then. And then in April, it kind of had a big pullback, and now we're testing those prior highs. And much like we heard from Mark, where he said he likes to see them as they're breaking out. I've got the PPO just starting to turn up on this technology name. I like it because it's not quite as commonly discussed as some of the other ones. What I want to see out of this chart, obviously, is that it continues to push higher, and it, from a technical perspective, I like it right here. If the PPO and the price action all starts to roll over here, I'm broadly concerned about technology. So that's my one. The one reason I'm a little more concerned there is that these technology names have all had such a big run. And if we're going to go back into value stocks, I'd rather be over in the materials than the oils. So.
Very good. 5 great picks. And you touched on a number of different topics, a number of different sectors as well. Just to refresh everyone's memory, we started with Freeport-McMoRan FCX, then to Southern Copper, and then Canadian Resources. So starting in materials and energy, and then finishing in technology with SQ and with PTC. I was struck, Greg, as you were describing how you were looking at things. You mentioned, I think the chart before last about the scooter ranking and being in names where it was above 70% or above the 70th percentile, really, right? Which means it's one of the stronger names. Can you just talk a little bit more about the importance of focusing on the strength using the scooter ranking, why that's part of the process when you're looking at all these different inputs?
Yeah, so one of the things about the scooter ranking, so if you think of a sports ranking system, keeping track of the number of wins and losses, what the scooter ranking does is it's basically a sports ranking system for stocks. Who's outperforming its peers? And the way we keep track of that is by percentage moves higher, and literally how far are you above your 40-week moving average, and how much momentum does the stock have going forward. So what we want to see is a strong stock that continually gets up into that top quadrant. Materials and oils have been underperforming for years, and we've recently just seen this big outperformance. You can see Freeport started back in May and went on for almost a full year. I'm of the belief that we're going to see that same scooter ranking move back up into the top and continue. And, it's Mercedes has said they want to be all electric by the end of the decade. BMW's got the same sort of thrust. All of these car companies that you need 6 times more copper to have an electric car. That doesn't talk about charging systems. That doesn't talk about all the new home construction. That doesn't talk about all the electronics that we have in our hands, and all the cables we have beside our bedside tables. So I'm very excited about the whole area of copper. I don't think the governments are approving mines anywhere near fast enough to keep up with the demand. And I think we actually go through, much like we did in lumber here recently, a big crunch. I see this big move into materials and energy continuing, and we've just started the wave higher.
Beautifully said, Greg. Thanks so much. Great picks, and let's discuss these further. All right. So as we're looking at these picks, and again, thank you guys so much for each putting in obviously a great amount of thought into where we're going with each of your picks. I'm struck by some of the similarities, but some of the differences with how you guys approach this. Number one, and I think as I was talking with Mark after his picks, I'm struck by how long-term the charts were that you guys each shared. All, none of you were giving me the short-term sort of play. You were all focusing on the long term, which makes me think, and any of you can take this, as we have this environment that, as we're recording this, the market's pulling back pretty good. I mean, it's down maybe 1%, but it feels like the biggest down day in history because we've had so few of them this year. How do you balance? I mean, what is the importance, or what would you see on the chart that would tell you the long-term picture is starting to change, right? How do we stay firm on a long-term thesis of equities working, given the uncertainty, given some of the movement that we've had, the volatility that we're having right now?
Yeah, it's a great question. If you don't mind, I'll just jump right in.
Yeah.
I think that we have seen the character of this market change pretty dramatically in the last few months, without a doubt. I mean, we've seen equal weighted indices all peak out in the month of June. The majority of the world peaked out. Europe peaked out in June also, whereas China and Japan largely peaked out in February. So it is a little bit of a different market where not everything is all moving up, just like U.S. technology. That being said, sentiment seems to have gotten very skittish, and that is an important piece of the technical equation as to at least how I view the world. And when you see concerns about growth, concerns about the Fed, when you see sentiment contract pretty substantially, sometimes it's very difficult to experience a very lengthy correction. So for me, I look at sentiment as being important, but I want to see June lows being broken. If technology is the market right now, then I have to look at technology. And for S&P and the NASDAQ, those need to break longer term uptrend lines from last March. We need to see a move down under June lows at a minimum, preferably May lows. We've seen divergences in transports, which are down 10%. Of course, small caps have been taken out to the woodshed with mid caps, but large caps with technology at 27% of the market are able to hold the market intact. And until that changes, you simply have to stick with, at least the benchmark indices and not try to be too defensive, specifically with the benchmark indices until we really see that breakdown. And so, I do think that in the months to come, we will see some evidence of that. But, I have to be sort of steadfast with, despite all the warnings, you don't want to get too defensive too quickly, and really watch the market indices themselves. And what we do as technicians, the bread and butter of the ruler method, and keep it simple, stupid, wait for the market to give us that signal. There's no need to jump the gun despite all the uncertainty.
It's so funny. I was telling my viewers on my show that with charts like Apple and Amazon, right? Or Microsoft, how negative do you want to be with some of these, stocks continuing to just pound away to new highs? Now, Jeff, you did a great job of sort of describing the reward versus the risk. I think more than anyone sort of described the risk potential for you. Is managing the volatility just about having good stops and making sure that you stay aware of them? Or is it a change of character on the charts, some of the ones that you pitched, that would cause you to be a little more cautious?
Yeah, I think both of those things, Dave. Honestly, we give the big picture view of the market our attention, just like everybody else does. And I would echo some of Mark's thoughts as well, that as long as the June lows hold on the major indices, then I think the uptrend is intact. So we draw a line in the sand there. But for individual equities, we're more concerned about, their idiosyncratic risk. And so our bottom-up work continues to populate a list of high relative strength names that are trending positively, that are leading the market. And so, in my 30 years experience in this business, I've seen numerous occasions where the market continues to make higher highs and surprise people all the way up as fewer and fewer stocks participate, but those are the key stocks. And it's when those stocks begin to break, that you need to become alert to the overall backdrop conditions. And today this week could be the key week. As you pointed out earlier, about a third of the stocks in the S&P 500 are reporting this week. And, in terms of the big five reporting, today through Thursday, that's about a quarter of the total market cap of the S&P 500. It could go either way. I mean, we saw Tesla put up a nice upside surprise, but, people poo-pooed it and sold the stock off in the market with it. So, can Apple and Google and Microsoft change the tone back to the positive? I'm actually pretty hopeful that that's the case. And if they do, I think this little pullback sets up a massive upside surprise. And so this is just what's necessary to create the conditions for the market to rally much, much higher. We've actually been out calling for a out of consensus 4,600 on the S&P 500 and 16,000 on the NASDAQ 100. And so it's possible we could get there this week or next week if we get the right news from these big heavyweights this week.
Yeah, it's all about the catalyst, right? Greg, it strikes me, I have to pick on you because you are the one who picked materials and energy. I'm not surprised given that is where, I mean, you have great understanding of that space. You've done such a great job being on the right side of those. But, none of us, not just you, but none of us picked any of the FANG stocks, Facebook, Microsoft, if we group that as the fan mag or whatever we want to call that group, right? Those mega cap names. And you obviously, opting a little more for some of the cyclical sectors. But what is it that you're not seeing? Or you'd mentioned some of the concerns about the growth space. What is it that would cause you not to pick, a FANG name right here, given the strength that we've seen so far?
So I do like the setups when you look at Apple and Amazon, how they are breaking out, trying to move to higher highs. I really like that. Microsoft looks really good here. Facebook and Google just continue to work. I think the bigger issue for me is when I look at the overall NASDAQ 100, if you look at the PPO line, which to me is everything I do is momentum based. So I'm making a second lower high in momentum. So right here, if we were to roll over, I'd be very worried. If we turn higher here, I'm with Jeff. We jump right back on the train higher, and it's a beautiful fourth quarter. But we're literally right at the trend line this week. I think 2 weeks ago, my newsletter said grizzly outlook, and last week I called it green eggs and ham because we literally just had green all over the screen, and I got egg in my face, and it was just very surprising. But we have only 50% of the stocks on the NASDAQ are above their 200-day moving average. Only 50% of the stocks in the New York are above the 200. I think it's 53% or something. So we're sitting here with a very finely balanced market in terms of the big leadership carrying on. Apple's only growing at 3%, but it's such a heavyweight. It's buying back shares enough to probably make that up when you got $100 billion buyback or whatever the number is. So don't get me wrong, I still think tech is okay. The big problem I have is that I'm just seeing a lot lower momentum. So as we come through this second phase, when I look at Zoom, it's stalling at the 200, Peloton stalling at the 200. I had a whole list. I had some other things like ARC stalling at the prior high. We have a couple of stocks in Canada, Lightspeed and Nuvi stalling at prior highs, Twilio at prior high. Moderna looks like a high volume stall to me. Square is testing these prior highs, PayPal testing the prior highs. So there's a lot of prior highs being tested this week. And I think that whole, we're in July again, which just, you go back and look at some of the big summer pullbacks, they kind of get through July earnings and all of a sudden they take a break in August where everybody just kind of pulls back and then we get set up for September. So maybe that's what's going on, but I don't like the significantly lower high in momentum. And I showed that on the Square chart and the PTC chart. So that's why I'm a little bit cautious on the tech area.
It's interesting. And having said that, though, as I was looking at your list right before we started, all of you, the one consistent group you all hit on was the payment processors. We had Square, PayPal, MasterCard, all identified. What is it about that space that's obviously drawing all of our attention? I don't disagree. I think some of the better setups seem to be there. What is it about that group, do you think, that's setting up so well, any of you?
When I was on the sell side, we used to call it chicken technology. That was the hiding place within technology, or in this case, now it's a hiding place in financials, perhaps, because many of those stocks have shifted to financials. But it is a more reliable set of earnings and revenue stream, basically, and so and it's particularly tied to the consumer. And if we're in a recovery, it's kind of a stealth recovery play as well.
It's interesting. You hit that is one. There are a number of groups that make any sort of sector, delineation very, very challenging. Solar stocks or media stocks, it's really hard to figure out where you should put them in a lot of ways. But payment processors too, right? They're tech, they're financials, they're consumer in some way. I mean, they're sort of a mix of everything, I would guess. As we're talking about those groups, I'm also thinking of what we did not touch on at all as a group, which was really anything defensive. Real estate has been one of the strongest sectors so far year to date, even given the strong uptrend. None of us picked a REIT. Now, I know these are not sexy names that probably any of us would probably pick, but Mark, why do we avoid in this sort of situation, given the uncertainty? Why are we staying away from anything truly defensive, you think?
Well, I think on an absolute basis, Dave, a lot of these still act very, very well. But on a relative basis, we've seen groups like consumer staples move down to new decade lows against the S&P. I mean, there are reasons why, if the stock market's going to be going higher, then you want to really avoid, getting too aggressive in the defensive names. I tend to think the consumer staples, there's a lot of stocks that act very, very well. Stocks like Pepsi and Coke and stocks that are breaking out that look great. But, they just wouldn't necessarily be one of my top 5. So if you gave us 50 stocks, and I'm sure I could find a few to throw in there, but that's just my own reason. I think that there'll be a time when, these groups will start to turn up very aggressively versus the S&P, and one will want to really overweight them on an intermediate term basis. But for now, I have to stick with tech. I have to stick with healthcare, which for me, the pharmas look great right now, and parts of materials. I think the dollar eventually turns back lower, and commodities probably will continue higher, and so that's a group that I like.
Yeah, it's unfair when I give each of you 5 stocks and then start picking things you did. I know that's a tough thing to do. Pick 5 out of 1,000. So right. Fair point, host. All right, back off, moderator. I get it. And it's interesting you mentioned with staples, right? I mean, I feel like with any of the sectors, you probably could find something like Costco. You mentioned like right. Pepsi. No, there's like something like Costco, right? Keeps making new highs. So there seem to be opportunities. What do you guys make, with the overall construct? I mean, you guys are all able to find stocks that certainly, based on the traditional technical approaches, are setting up very well. And you guys are able to find stocks that are basing, that are starting to break out. Should we be concerned about the charts like Tesla? You mentioned ARK Innovation Fund, ARKK, Greg. These are charts that are not breaking out. These are charts that are not constructive. How much of a concern is it that sort of what may be seen as the juice, right? The offense, it's not kind of working. I mean, Greg, how much of an issue is that for you, do you think?
It's huge. I think one of the things we saw that real shift in volume in December, January, February. I think the NASDAQ went up from a summer base last summer of around 4 billion shares to 10 billion for the month. It was crazy how much extra volume we were hitting. And I think that was weekly. Like it was just literally, we were surging in phenomenal volume. And then we kind of hit that top on the electric vehicles and all the meme stocks in around mid-February, had our pullback. I think the bigger issue around that whole area is that we just have so much competition coming, and all of these automakers are trying to rush over into that space. And I think it's there's more players coming on. So that whole area looks a little difficult to pick a winner, and they've run for a while. The concern I have is when I look around, like a lot of these names, even the technology names, are up 10x or up 5x or whatever. How much time do they need before their balance sheet catches up to the price that we've put on the stock? And Shopify is a Canadian favorite, also on the US side. It's 60 times revenue, not 60 times earnings. Like it's trading crazy levels. And so you have to sit there and just say, how much of that can I own with that sort of future forward value already calculated in?
Interesting. Jeff, when you're thinking about Tesla, it's funny, earlier this year, we did Greg was actually on the Chart Madness special we did. It was a March Madness theme stock picking discussion. I remember one of the matchups in particular, it was sort of like the old versus new car approach. It was Ford versus Tesla. And if I remember, I think you and I both picked Ford in that discussion, Greg, if I remember right.
We did,
but
yeah.
Jeff, it's interesting, when you're looking at the chart of Tesla, it's sort of underwhelming. But when you think about what has exposure to this, emerging theme, it could be things like Alphabet and Ford. It's sort of like the names you would not normally think of, but it's not just NIO and others. So when you're thinking of that, the chart of, and not to put you 200 gun on one particular name, but Tesla is obviously one that's central to us. This is a chart that's been range bound. It's sort of between 550 and 700. What would you need to see on a chart like that would cause it to maybe be one of your 5 in a situation like this?
I'd need to see a new all-time high.
Yeah.
Here's the thing, Dave. that stock is not trending. And when stocks are not trending, they're of no interest to me whatsoever as a trend follower. Having said that, I wouldn't write Cathie Wood off just yet. I mean, it's basing, the ARK Innovation Fund is basing, Tesla's the largest holding in it. Tesla might also be basing, we don't know yet, right? It hasn't broken out. It continues to trade below key moving averages, which tell me that the trend is just, it doesn't exist at this point. It hasn't redefined a new downtrend either. I mean, I actually went out with a preemptive short call about a month ago and got egg on my face. So, it was a little too early, but again, we use a stop loss in order to protect capital. So, and we also position size properly in these things. So it didn't hurt, it was just one more name and a lot of names. Another thing I would mention is crypto. Crypto had a big move yesterday, led by Bitcoin and Ethereum. And honestly, I wouldn't write that off just yet either. It speaks to change in sentiment. And I'm not sure what the catalyst was. We know that China had something to do with the fact that it started to sell off and the fact that it was very extended. And I would just speak to, a lot of things got very extended. You asked the question earlier, why didn't anybody pick a FANG stock? Well, I love all the stocks. There's some of my biggest positions right now, but they've moved a little too far to initiate a new position in necessarily. Google and Microsoft, most certainly, to a lesser extent, Apple and Amazon. But if I had to pick one, I'd pick Amazon because I like retail. And one of the big bets that I've made is Dollar General as well, another retailer. So, discretionary is not a space that's out of sync necessarily with where the market's going. It's just very selective. You gotta strip out all the hotels, the airlines, and the restaurants to get to what's working.
It's interesting, Jeff, you brought up cryptocurrencies, and it's funny when we have a paper portfolio competition with the StockCharts TV team. So it's a couple of us who are, technical analysts, but most of the team are graphic designers and producers. I won't tell you where your moderator is in the rankings right now versus some of my teammates. It's not going well so far for me. But I would tell you that it's funny, when we first did the competition, I did not remove cryptos as one of the choices, and half the team put some sort of cryptocurrencies in their portfolio, and I ended up taking it out because I wanted us to focus on stocks. But I'm curious, you mentioned cryptos, Jeff, for Mark or for Greg, if you had the opportunity to have Bitcoin as one of your stocks or a cryptocurrency, would that have even entered into your top 5 anywhere near there, or is there something that would have prevented you from putting something like that as a top idea right now, and why?
I would say that for me, just looking at momentum on the cryptos, typically they need more time off. They need like 9 months off, and this has only been like 4 or 5. So I'm kind of waiting for the upturn to start again. But the bounce that we had this week was actually the first time we actually saw momentum change for quite a while. So that was at least hopeful. But I would just say, the big blow off top that we kind of had back in the first quarter looks to me like crypto just needs more time to relax before it's going to start making its next leg.
To find the top 5, I certainly wouldn't be selecting something that is down 50% over the last 3 or 4 months. I think that most of us tend to be trend following technicians, momentum based. If this starts to really move up aggressively, then it's something I'll have to pay attention to. I've owned crypto in the past. I sold all of my exposure between January and March. I was a few months early, but I've avoided a lot of this downdraft, and some of the cycles I show are still a little early for this year or even next year. And over time, it is wise to buy dips, of course, if you're long-term buy and hold. It's got a great long-term uptrend on a log basis, but near term, there are better opportunities, and it's just too volatile to buy something that hasn't properly stabilized, in my view, that has just a minor move off the lows. So when it's time and weekly and monthly momentum start to turn up again sharply, then I'll certainly participate.
Yeah, I would echo those comments, actually. I think it's a better sentiment gauge right now than it is a trading instrument. For me, I would definitely stay centered around Bitcoin and Ethereum because they're institutional markets and there's a lot of liquidity there, but neither of them are viable, in my opinion, until they begin to reestablish their uptrend. And in the case of Ethereum, there is a pretty strong use case for that in the real world. And so it's something to pay attention to. In terms of Bitcoin, it's getting a lot of attention from disruptors like Elon Musk and Cathie Wood and, MicroStrategy, within the corporate sector. And we could see more of that. And I think as the institutional participation evolves, it could then become more of a viable asset class. But right now, I think we're officially neutral, and we'll stay neutral until it begins to reassert its uptrend.
Well said, each of you. You guys had great responses for that. Guys, we're out of time. That went quickly. It was a lot of fun. I wish we could keep this going for hours. You guys are really, really thoughtful. I respect each of you a great deal. And it was a pleasure to pick your brains a little bit. It's funny, as you guys were each talking, I don't know how familiar each of you are with each other's work, but I hope you saw a lot of similarities. Why we asked the three of you to join. You guys have a great focus on momentum, on trend, and on letting the charts tell the story. And it's interesting. I always tell our viewers on StockCharts TV, your job is to do three things. Number one, identify the trends. Number two, follow those trends. And number three, identify or anticipate when those trends may be exhausted. And I appreciate what each of you guys have done today to help us try to answer those three questions. So a special thank you to each of you, Greg Schnell, Jeff Hughes, Mark Newton, for joining us today. You guys did fantastic. Appreciate you putting yourselves on the line a bit and giving us some picks, but defending them admirably and having a great discussion as well. Thanks so much for joining each of you guys. I appreciate it.
Thank you, Dave.
So everyone, that's it for the pitch. Thank you so much for joining us every month as we ask three guests to pick 5 names for us and describe their thinking. It's a great opportunity to learn from some of the great strategists, investors, and traders out there in the markets. Really appreciate Jeff Hughes, Greg Schnell, and Mark Newton joining us for today. As a reminder, go to stockchartstv.com/thepitch for all the information on the show, and go to our on-demand platform, stockchartstv.com, for this show and all the great content we produce on StockCharts TV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good one. We'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.